Okay, let's be real. How many of us actually do a happy dance when we see that tax return email in our inbox? It's not exactly like winning the lottery, is it?
Well, it doesn't have to be a root canal either.
True. Especially if we're armed with the right knowledge, which is why we're diving deep into how to maximize your tax return today. Because, let's face it, a lot of us, and by a lot, I mean a recent Gallup survey, found a whopping 60% of Americans feel like we're forking over way too much in federal income tax.
It's a common concern, for sure. But the good news is there are absolutely ways to keep more of your hard-earned cash. It all comes down to strategy.
And that's what we're here for, to break it down and make it feel less like deciphering ancient hieroglyphics.
I like that analogy.
So the guy jumps right into filing statuses, which, I'll admit, always makes my head spin a little. It's like one of those choose the wrong door and face the tax monster situations.
Huh. I can see why it feels that way. But in reality, most of the options are fairly straightforward. Single, married filing jointly, qualifying widow or widower. But then there are a couple that tend to cause some confusion, like married filing separately.
Yeah, married filing separately always makes me think there's a dramatic backstory involving an audit and maybe some hidden assets. Is that usually as ominous as it sounds?
Well, not necessarily. It can actually be advantageous in certain scenarios, like if a couple has vastly different incomes or some complex financial entanglements. But generally speaking, it can lead to a higher tax bill overall. The best approach is to run the numbers both ways, filing jointly versus separately, to see which one shakes out better for your specific situation. But here's where it gets interesting. The head of household status.
Ooh, okay, that one always throws me for a loop.
It can be a real game changer, though. This status can actually be far more beneficial than filing as single, even if you're, well, single and living solo.
Wait, really? So I don't have to actually be, the head of a traditional household to qualify?
Not at all. The requirements are a little specific, but it boils down to this. You have to be unmarried and shouldering more than half the costs of running a household for more than half the year. And here's the catch. You also need a qualifying child or dependent living with you.
Okay, now that sounds like something you'd want to double check with a professional.
It never hurts to have a second set of eyes. And that's especially true as we start wading into the wonderful world of deductions.
Deductions. Now we're talking my language.
Think of deductions as those trusty sidekicks that swoop in to reduce the amount of your income that's actually taxable. They're here to help.
I like the sound of that. So how do we make these deductions work their magic? Give us the inside scoop.
Our handy-dandy guide highlights this crucial first decision you'll need to make itemizing versus taking the standard deduction.
That part always seems to trip me up. Can we break that down a bit?
Absolutely. After the Tax Cuts and Jobs Act, or TCJA, back in 2017, the standard deduction got a nice little boost. This made it a more appealing choice for a lot of taxpayers. And keep in mind that those amounts are adjusted annually to keep pace with inflation. So for single filers in 2023, that was $13,850, which then jumped up to $14,600 for 2024.
And what about those of us who are doing the whole happily ever after thing? What were the numbers for married couples filing jointly?
For 23, that was $27,700, and then it decreased to $29,200 in 24.
So if you're not exactly the type who meticulously logs every receipt into a spreadsheet or, enjoys spending weekends lost in a maze of paperwork, the standard deduction might be the way to go.
You got it. It's definitely the more streamlined approach, but hold on, there's a little bonus for those who are 65 or older.
Oh, that's right. Our trusty guide mentioned an extra deduction for seniors. What are the details on that?
So it's an additional $8,850 for those filing as single or head of household, and $1,500 per person for married couples in 2023. And of course, those amounts see a slight bump for the 2024 tax year. It's easily overlooked, but it can be a real advantage for older taxpayers.
Definitely worth noting. Now, for anyone who does decide to brave the itemizing waters, what are some of the big ticket deductions they should keep on their radar?
The guide calls out a few major ones that tend to pack a punch. Home ownership, for starters. Things like mortgage interest and those ever-present property taxes can really add up. Then there are medical expenses. Anything exceeding 7.5% of your adjusted gross income, or AGI for short, is fair game for a deduction. And never underestimate the power of generosity.
Right. Giving back can actually help you save on taxes.
It's true. Charitable donations can actually lower your tax burden. Generally, you can deduct up to 20% of your AGI for most charitable organizations, although there are a few exceptions that allow you to go up to 60%.
So it literally pays to be generous.
I love it. Speaking of things that pay, the guide also mentions these mysterious above-the-line deductions. What's the deal with those?
Ah, yes. Above-the-line deductions are like bonus points in the game of taxes because you can claim them even if you don't itemize. Think student loan interest, certain educator expenses, or contributions to a health savings account or HSA. They're like little gifts from the IRS.
It's like stumbling upon a secret level in a video game. Now, while we're on the topic of things that feel a little bit like winning, tell me more about deducting gambling losses. Is that actually a thing?
You better believe it. Well, like anything tax-related, there are a few rules we have to follow. The IRS, in all its wisdom, does allow you to deduct gambling losses. But, and this is a big but only up to the amount you win, so that lucky streak at the blackjack table can be offset by any losses you incurred during that same period. Just make sure you've got the receipts to back it up, because the IRS loves receipts. Always a good idea to keep those receipts handy, even if it's from those, shall we say, less than legitimate casinos. You know, the ones where you might have to dodge a few tumbleweeds to get there.
Absolutely. Proper documentation is your best friend when it comes to taxes. And while we're on the subject, another deduction that tends to trip people up is the one for student loan interest.
Because nothing says adulting like trying to decode income phase-outs and eligibility requirements, am I right?
You hit the nail on the head. It can feel like you need a PhD in tax law to figure it all out, but we'll try to make it as painless as possible. So in 2023, that deduction started to phase out if your modified adjusted gross income, or MBGI, was over $75,000 or $155,000 for those filing jointly. And once your MGI hit $90,000 or $185,000 for couples, poof, the deduction vanished entirely. And just to keep things interesting, those thresholds get a slight bump up for 2024.
Oh, great. Just when you thought you had it all figured out. So it's not a bad idea to keep an eye on those income limits because they can shift from year to year.
Exactly. Stay informed, my friend. Knowledge is power, especially when it comes to taxes.
Words to live by. Now, another section that caught my eye was the one on small business expenses. This feels super relevant these days with so many people embracing the whole freelancing and gig economy lifestyle.
You're absolutely right. It's definitely a hot topic. And one of the perks of being your own boss, whether you're freelancing or running your own business, is the ability to deduct a portion of those home expenses if you have a dedicated workspace. Plus, you can often deduct business travel and even those pesky health insurance premiums. But here's the thing. Meticulous record keeping is essential. You really need to understand the specific requirements for each deduction. Otherwise, you could find yourself in a bit of a pickle come tax time.
Solid advice. Now, we've covered deductions, which are obviously fantastic, but the guide also delves into the world of tax credits. Yeah. What's the difference there? Are we talking about the same thing, or are these two different beasts?
They're definitely related, but not quite the same. Think of deductions as shrinking your taxable income, while tax credits, on the other hand, directly reduce your tax bill dollar for dollar.
So instead of that $20 bill you find in your old jeans going towards a questionable energy drink, it goes towards lowering your taxes.
Precisely. It's like getting a discount on what you owe.
Okay, I'm liking the sound of this. Are there different types of tax credits we should be aware of?
You bet. What makes some credits even better than others is that they're actually refundable. That means if those credits wipe out your tax liability completely, like down to zero, you might actually get money back from the IRS.
Hold on, did you just say getting money back from the IRS? Is that even legal? It almost sounds enjoyable.
It's the holy grail of tax season. Now, it's important to note that non-refundable credits can only reduce your tax bill to zero. You won't get any extra cash back in your pocket. But hey, a zero tax bill is still a major win in my book.
Absolutely. Who am I to argue with free money?
Mm-hmm.
So which of these magical tax credits should we be on the lookout for?
There are a few heavy hitters highlighted in the guide that you definitely don't want to miss. The child tax credit is a big one for parents with kids under 17. For 2023, that was a cool $2,000 per qualifying child for those earning up to $200,000 or $400,000 for joint filers. But, and this is important, that amount gradually decreases as your income goes above those thresholds. Then we have the Child Independent Care Credit, which is a lifesaver for those paying for childcare for little ones under 12.
Which, let's be honest, can really put a dent in your budget. So it's good to know there's some potential tax relief available there. What other credits should we add to our list?
We can't forget about the Earned Income Tax Credit, often shortened to EITC. This one is designed specifically to give tax breaks to those incredible low to moderate income workers and families who are the backbone of our economy. It's all about providing a little extra support where it's needed most.
It's heartening to know those options exist for the folks who need it most. Any other credits we should put on our radar?
The guide also shines a spotlight on the residential clean energy credit. This one's for all of us who are trying to make our homes a little greener and more energy efficient. Basically, if you install qualified clean energy technology in your humble abode anytime between 2022 and 2032, you could be eligible for a sweet credit of 30% of the costs. Good for the planet and good for your wallet. It's a win-win.
Now, that's what I call a smart investment. It's like this guide is handing us a treasure map, but instead of leading to buried gold, it's leading us to a fatter wallet come tax season. Speaking of which, let's talk about retirement accounts. I'm all about investing in my future self and ensuring those golden years are actually, well, golden.
Music to my ears. When it comes to retirement contributions, here's the key takeaway. You're strategically reducing the portion of your income that's subject to those pesky taxes. It's a win-win situation. You're saving for the future and lowering your tax bill in the present. What's not to love?
Okay, I'm definitely on board with this strategy. So if I'm diligently maxing out my 401k contributions like a responsible adult, I'm essentially shrinking my taxable income for the year, which means I'll owe less in taxes. Am I getting this right?
You got it. You're catching on quickly. Let's say, just for kicks, that you earned $100,000 last year, but you were a rock star and diligently socked away $20,000 into your 401k.
I like where this is going.
So instead of owing taxes on that full $100,000, your taxable income is now a cool $80,000. The beauty of these traditional retirement accounts, like your 401k or a traditional IRA, is that you're essentially pressing the pause button on paying taxes on that money. You won't have to fork it over to Uncle Sam until you withdraw those funds in retirement.
When hopefully we're lounging on a beach somewhere, sipping something tropical and enjoying a lower tax bracket, right?
Here's to hoping.
Cheers to that.
Yeah.
But what about Roth IRAs? I feel like those are super popular these days. Everyone's talking about them. Is there a reason why I should be prioritizing those over, say, a traditional IRA or a 401k?
They're definitely having a moment. And for good reason. They offer a lot of flexibility and can be a great tool for building long-term wealth. However, there is a key difference when we're talking about taxes. The guide points out that, unlike traditional IRAs or 401ks, contributions to a Roth IRA don't actually impact your current year tax return. Why is that, you ask? Well, it's because you're funding a Roth IRA with money you've already paid taxes on.
So it's like I'm paying my dues up front, but then it's smooth sailing in retirement.
Precisely. While you won't see an immediate reduction in your taxable income with a Roth IRA like you would with a traditional IRA or 401k, the plus side is that all the growth and qualified withdrawals in retirement are completely tax-free. It's like a delicious bonus at the end of the road.
So it's like choosing between a delicious appetizer now or saving room for an even more fantastic dessert later. Tough choices.
That's a tasty way to put it. At the end of the day, the best choice for you really depends on your individual circumstances, your risk tolerance, and your long-term financial goals. It's all about finding the strategy that aligns with your unique situation.
Makes sense. So is there a right answer when it comes to choosing between a Roth and a traditional account? Or is it more about weighing the pros and cons?
It's definitely more nuanced than a simple yes or no answer. The most important thing, regardless of which type of account you choose, is to contribute as much as you can, as often as you can. The key takeaway is that maximizing those contributions, whether it's a traditional or Roth IRA, a 401k, or an HSA, is like giving your future self a financial high five.
Love it. And since we're on a roll with planning for the future, I know the guide gets into a topic that tends to cause a lot of confusion and anxiety withholding. You know, making sure we're not accidentally shortchanging Uncle Sam throughout the year, or, on the flip side, giving the government an interest-free loan.
It's definitely a delicate dance, but it's one we all have to participate in. And like any good dance, it's all about finding that sweet spot, that perfect balance where you're withholding enough to cover your tax liability without overdoing it, and handing the government a wad of cash that could be earning you interest in a savings account.
Because who wants to wait a whole year to get their own hard-earned money back?
Yeah.
It's like the guide said, a whopping 70% of us over-withhold each year.
It's true. It's incredibly common, and it usually stems from this fear of owing taxes. But think of it this way. That extra money just sitting in the government's coffers all year, that could be money working for you, earning you interest, or being invested.
Okay, that makes me feel better. So it's all about finding that balance between withholding too little, which could result in a nasty surprise come tax time, and withholding too much, which is basically like handing the IRS a free loan. But how do we actually find that middle ground? It feels like a moving target.
Fortunately, the IRS does offer a super helpful tool called the tax withholding estimator. It's like a crystal ball for your taxes. You plug in your specific financial information, your income, deductions, credits, all that good stuff, and it crunches the numbers to help determine if your withholding is on track or if you need to make some adjustments.
That sounds incredibly helpful. It's like having a personal tax advisor at your fingertips.
Mm-hmm.
But what if the estimator shows that you need to, tweak things a bit? What then?
Then it's time to break out the infamous Form W-4. This is how you officially communicate your withholding preferences to your employer, who then adjusts how much tax is withheld from each paycheck. It's all about taking control and making sure you're withholding the right amount.
So it sounds like regularly checking in with the IRS tax withholding estimator and being open to tweaking your W-4 as needed can save a lot of headaches and potentially put some extra cash back in your pocket.
You got it. And speaking of taking a proactive approach to managing your money, the guide outlines some really savvy strategies for something called strategic tax planning.
Okay, now that sounds empowering. It's like we're playing chess with our finances instead of checkers.
I love that analogy. That's exactly what it is. Strategic tax planning is all about making smart, calculated moves throughout the year to minimize your tax liability. It's about being proactive rather than scrambling when tax season rolls around. It's about being the master of your financial domain. It's all about having a plan, right? So for 2023, you could contribute up to $3,850 if you had an individual plan, or $7,750 for a family plan.
And the numbers change for 2024, if I'm remembering correctly from the guide.
Right. They got a little bump up. So for 2024, it's $4,150 for individuals. And for families, we're looking at $8,300.
Okay, so those are some pretty significant differences worth paying attention to.
Absolutely. Every little bit counts when it comes to saving for the future. And don't forget about those who are 55 or older. You've got that extra catch-up contribution of $1,000. It's like a bonus round for retirement saving.
I love a good bonus. It really highlights the fact that this guide isn't just about, understanding these complex tax rules that, frankly, make my head spin sometimes. It's about making smart choices all year round, right?
You hit the nail on the head. It's like having a financial roadmap. But instead of leading to buried treasure, it leads to a fatter wallet come tax season. And who doesn't love a fatter wallet?
Speaking of maximizing those returns, let's dive into a topic that I think sometimes gets overlooked, the power of those tax-advantaged accounts. They sound kind of boring, but they can really pack a punch, right?
Oh, absolutely. This is where things get really exciting. We've already touched on HSAs, but those traditional and Roth IRAs and 401ks, those are your best friends when it comes to keeping more of your money. Remember how we talked about deductions shrinking your taxable income? Well, these accounts take it a step further. They're like the superheroes of the financial world. They allow your investments to grow either tax-deferred or, in some cases, completely tax-free.
Wait, did you say completely tax-free? Like Uncle Sam just looks the other way?
Well, not exactly. It's more like you're paying your dues up front or delaying them until later. But the point is, you get to keep more of your hard-earned money, which is always a good thing.
Okay, so it's not just about how much we're earning. It's about sheltering those earnings from the taxman as much as possible.
Exactly. You've got it. It's about being strategic and making your money work harder for you.
All right, break it down for me. I'm ready to put on my investor hat.
So with a traditional IRA or a 401k, you're contributing pre-tax dollars, which essentially shrinks your taxable income right off the bat. The money you invest then gets to grow tax-deferred, meaning you won't owe a dime in taxes until you withdraw those funds in retirement, and ideally you'll be in a lower tax bracket by then, so you'll get to keep even more of your money.
So it's like I'm hitting the pause button on paying those taxes and letting my money grow more freely in the meantime. I like it.
Exactly. You're a natural at this. Now, with a Roth IRA, it's a little different. Instead of getting a tax break up front, you contribute after-tax dollars, meaning there's no immediate impact on your tax return. But here's the beautiful trade-off. All that growth and those qualified withdrawals in retirement, totally tax-free.
So it's like choosing between a guaranteed return now or the potential for even bigger rewards later on. Decisions.
I know, right? It's like trying to choose between your favorite desserts. But honestly, the best option for you really depends on your own unique circumstances and those long-term financial goals. Are you planning to retire on a private island? Maybe your Roth is the way to go. Or perhaps you're more of a live-in-the-moment kind of person who wants to lower their tax bill right now. In that case, a traditional account might be the better fit. But no matter what, the most important thing is that you're contributing as much as you can, as often as you can, to some kind of retirement account.
Got it. So more important than choosing the right type of account is just getting in the game and contributing something.
Right. 100%. Think of it like this. Those consistent contributions, they're like planting seeds. You might not see much happening at first, but over time, with a little patience and the magic of compound growth, those little seeds can blossom into a beautiful retirement garden.
Okay, now that's an analogy I can get behind. So these tax-advantaged accounts, they're like having a secret weapon in the fight against taxes, right?
They're like having a secret weapon, A&D, a financial advisor, all rolled into one. But I get what you're saying. It can be a little overwhelming trying to figure out which accounts are right for you, how much to contribute, all of that.
Right, especially for those of us who don't exactly have a finance degree. Any advice for someone who's feeling a little lost in the world of retirement savings?
Don't worry, you're not alone. A lot of people feel intimidated by this stuff. My advice would be, don't be afraid to ask for help. Talk to a financial advisor. They can help you figure out what makes sense for your specific situation and goals. And remember, you don't have to do it all at once. Start small if you need to. Even if you can only contribute a little bit each month, it's going to add up over time, thanks to the beauty of compound growth.
Small steps, big rewards. I love it. Now let's shift gears and talk about something a little less exciting, but equally important: tax software versus hiring a professional. Our guide seems to be team professional all the way. What's your take?
I'm definitely a fan of having a professional in your corner, especially when it comes to something as important as your taxes. Don't get me wrong, there are some fantastic DIY tax software options out there that can be super helpful for simple tax situations. But if you're dealing with anything even remotely complicated, having an expert on your side can be invaluable.
It's kind of like you could try to fix that leaky faucet yourself. Or you could call a plumber and be confident it's done right.
Exactly. Think of it like building a house. You could try to tackle it yourself, but wouldn't you feel a whole lot more confident with an experienced architect and a skilled contractor on your team?
Especially if I'm planning to actually live in that house, right?
Yeah.
I don't want it collapsing on me. So in what situations does it make sense to, swallow your pride and call in the tax pros?
The guide calls out a few scenarios where it's almost always a good idea to seek professional guidance. Like, if you're planning to itemize your deductions, for instance, or if you're self-employed, dealing with those complex business income and expense forms, definitely call in the experts for that. And anytime you experience a major life event during the tax year, whether it's marriage, divorce, the birth of a child, or even inheriting a large sum of money, those situations can create a whole new level of complexity on your tax return. And a professional can help you navigate those nuances and make sure you're not missing out on any potential deductions or credits.
It's like having a financial coach in your corner, helping you strategize and make the most of every opportunity.
Right? Exactly. They're like your financial cheerleaders, guiding you towards financial success. And speaking of opportunities, if you have significant investments, a tax professional can provide really valuable insights on strategies like tax loss harvesting, which we talked about earlier, to help minimize your tax liability and keep more of your hard-earned money growing.
So basically, if your financial situation is a little more complex than, say, a game of Candyland, it's probably a good idea to have a professional on speed dial.
You got it. Think of them as your financial superheroes swooping in to save the day.
I like the way you think. Now, this might seem obvious, but with so many tax professionals out there, how do you even begin to find the right one for you? It feels a little overwhelming.
I hear you. It's like trying to find a needle in a haystack sometimes, but it doesn't have to be stressful. A good place to start is with your own personal network. Reach out to friends, family members, colleagues, anyone you trust, and see if they have any recommendations. Online community groups can also be gold mines of information. Once you've got a few names, take the time to schedule a quick chat with each one. Think of it like a financial meet and greet.
Ooh, I like that. Like a speed dating event, but for your finances.
Exactly. It's a chance to get a feel for their communication style, their level of expertise, and whether or not you vibe with them. Because just like any professional, you want to make sure there's good rapport and that you feel comfortable entrusting them with your financial well-being.
It's a relationship. You're trusting them with some pretty important stuff.
Absolutely. And remember, you're not obligated to work with the first person you meet. Shop around, ask questions, and don't settle until you find someone you feel confident will be a valuable asset to your financial dream team. It's your money, your future. You deserve the best.
Couldn't have said it better myself. Well, as we start to wrap up our deep dive into the world of maximizing tax returns, I have to say I'm feeling a lot more empowered than I did when we started. It's like we've been handed a toolkit filled with strategies and insights to help us take control of our finances and, dare I say, make tax season a little less painful.
That's what I love to hear. And remember, this isn't about memorizing every single tax rule or becoming a financial expert overnight. It's about understanding the key principles, making informed decisions throughout the year that align with your goals, and seeking guidance when you need it. And trust me, there are tons of resources available to help you along the way, like the IRS website. It can actually be pretty helpful.
Right. The IRS website isn't exactly known for being user-friendly, but they've actually made some good improvements in recent years.
They're trying. And don't forget those IRS publications. Those can be super helpful for getting more detailed information and clarification on specific tax topics.
Knowledge is power. Or at least it makes us feel a little less powerless when those tax forms start rolling in.
It does. It's nice to know we're not alone in this crazy world of taxes. There's help out there if we need it.
Exactly. Don't be afraid to reach out to the experts. They're there to help you navigate the ins and outs of it all.
So, as we wrap up our deep dive into maximizing those tax returns, what's the one thing you hope our listeners will take away from our conversation today?
Honestly, I just want everyone listening to feel empowered.
Yeah.
Empowered to take control of their tax situation, because it doesn't have to be this big, scary, overwhelming thing.
Right. It's not like we have to become tax attorneys overnight or anything.
Exactly. It's not about tricks or loopholes or trying to outsmart the system. It's really about understanding the tools and strategies that are available to you, completely legally, might I add, and using them to your advantage.
It's about being proactive with our finances instead of just reacting when that tax deadline starts looming, right? You nailed it. Don't wait until the last minute. Start thinking about your taxes now. Consider your financial goals for the year for the next 5 years. For retirement, what are you working towards? Then do your research, explore your options, and hey, if it all feels a bit overwhelming, don't hesitate to bring in a qualified professional to guide you.
It's like that old saying, the best time to plant a tree was 20 years ago. The second best time is now.
I love that. So true. And it applies to your finances too. Don't wait. Start today, even if it's just taking a small step. Maybe it's creating a budget or finally opening that retirement account you've been putting off, or even just scheduling a quick consultation with a financial advisor to get the ball rolling. Small steps can lead to big results over time. You just have to start somewhere.
I love that. Such great advice. It's been an absolute pleasure diving into these strategies with you today. You've given us so much to think about and act on.
The pleasure was all mine. Seriously, I love talking about this stuff. And remember, knowledge is power. Now you have the tools to make your money work harder for you, so go out there and conquer those taxes.
Yes. Channel your inner financial superhero. To all our amazing listeners, thank you for joining us on this deep dive into maximizing your tax return. We hope you've picked up some valuable tips and tricks, and most importantly, that you feel inspired and motivated to take control of your financial future. Now go forth and make those money moves. Happy saving, everyone.